Right.
Good afternoon, ladies and gentlemen, and welcome to the Bloomsbury Publishing plc Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so, and these will be available via your Investor Meet company dashboard. Before we begin, I would like to submit the following poll, and I would now like to hand you over to the executive management team from Bloomsbury Publishing plc. Nigel, Penny, good afternoon.
Good afternoon, and a very warm welcome to all of you, and thank you very much for coming to this presentation of our interim results. On the first slide, you'll see reference to our fourth consecutive double-digit growth period in the first half of the year. This is a great strategic victory for Bloomsbury because we used to have very year-end weighted years because of the Christmas gift book market coming right at the end. But we've worked hard over the last decade to try to create a more balanced year. And one of the main planks of that has been the development of our academic publishing list, which has its high points much earlier in the year than Christmas, and has given us the balance that we're now starting to achieve, which will be reflected in the dividend phasing, as we will come on to later in this presentation. As you've seen, profits are up 11%, as are sales. We refer there to the flywheel effect that we're benefiting from, and also to the growth in our digital channels and BDR revenue, and finally an increase in the dividend. If we can go on to the next slide, please.
So good afternoon, everyone. Taking you through the key things on this financial highlights page. Nigel's already mentioned our 11% growth in both revenue and profit in this first half that we're very proud of. And then I'd also like to call your attention to the 14% growth in the EPS figure. And finally, just reiterating what Nigel said about the change in the balance of the dividends. So the dividend's gone from 141 to 370 pence, and that's a change in the balance. So the full year expectation remains unchanged. So moving on to what's behind these great results, we look on the left-hand side, and that's the consumer division. So that's effectively our trade director consumer sales. You can see there's 17% growth in the revenue, 26% growth in the profit, and that's our margin increasing by a basis point. And on the non-consumer side, so this includes our academic and professional sales, we've increased that by 2%, and we'll come on to what's in the margin mix a bit later on. So looking in more detail at the revenue, this breaks it down by the subdivision. So you've seen there 8% growth in our adult division. Some of you who've been following us for some time will know that we've been putting a lot of time and effort into adult and changing our focus here, and that's really good to see that delivering. 22% growth in children's, really exceptional, but it's very encouraging to see the strong consumer demand for our content across both adult and children's. Within academic and professional, we were in line with the first half last year, where we grew by 38%. And we were very pleased with our 7% growth in special interest. And that, as some of you know, is our niche targeted publishing for niche communities. So whether it's around sailing or cricket or wildlife. So moving on to the different channels. So you can see 8% growth in print. So you can see that continued strong demand for print, and that's very much weighted towards the consumer side. So we're seeing no drop off in appetite at all. In fact, quite the opposite for consumers' demand to read in both print as well as in ebook or audio formats. You can see there's 32% growth in ebooks. So that's growth in the ebook format for both the academic and professional division, particularly strongly, but also consumers. Certain books lend themselves, but people really want these in both formats or in all formats. And just a reminder to this audience, we are totally platform agnostic. So our aim is to produce fantastic content that our customers want and then put that into whatever channel best suits that customer. I'd particularly like to highlight the 48% growth in audio in this first half. So audio is something that we've seen great potential in for some years now. It took a bit of a backseat in the pandemic because it's very much driven by consumer behaviour. But now that people are properly travelling and doing all the other activities that we were very limited on for a while, we're really seeing this growth. And this is an interesting channel because it's mainly additive. People consume audiobooks at a time travelling, at the gym, walking or whatever, or running, when they wouldn't be able to consume either a print or an ebook. So this is very much additive. And then the final point here is on the BDR, where we consolidated last year's first half growth, which was 69%. So an incredible comp there for us to consolidate and hold on to. So moving on then to update you on our strong financial position, updating you here with the key metric here is on the cash. So we have just over 39 million pounds as at the end of August, and that provides the basis for our very strong war chest for future acquisitions, which we'll talk more about later on in this presentation. But the acquisitions remains a key part of our strategy, and this firepower is important to what we can continue to achieve here. Looking at our first half cash flow, we've highlighted here the key movements both in and out, and what's come to there. I think one thing I draw your attention to here is on the right-hand side, where we talk about advances. So we paid out advances of just over 11 million in the first half, and that's 3 million up on last year. And advances represent effectively our future consumer pipeline. So the fact that that's increasing is very healthy. And just a reminder that these are effectively prepayments of royalties to our authors that are paid. The first tranche is paid on the signature, and then they're paid when the manuscript is delivered, when the hardback is published, and when the paperback is published. So Nigel,
here is the dividend slide. As you can see, we've continued our pattern of growth. Of course, the August 23 bar is determined by the change in the phasing rather than a change in the fundamental amount of the dividend for the reasons that I discussed earlier. And we're aiming to keep cover on the dividend in excess of 2 times, and we're maintaining our full year dividend guidance. Thank you. So looking at the investment case, I can't stress too much the importance of our combination of general publishing, or consumer as we call it, and academic publishing. Very few, if any, other publishers of our size do this. It is our strength. It means that we can claim to be a portfolio of portfolios because they have completely different sets of customers, so we aren't tied to the fate of the high street, for example, because we're also benefiting from the institutional budgets that fund most academic sales. You can see there 127% growth in adjusted diluted EPS growth over 5 years to this year. And looking down at the acquisitions box at the bottom, Bloomsbury have made 19 strategic acquisitions since 2008. In fact, over 30 since 2000. We've built ourselves to being one of the strongest and most successful independent academic publishers, as well as continuing to be a robust publisher of best-selling books for the general market as well. We continue to be approached by people who are looking to divest, and the deal flow is good, and we're hopeful that we will continue our track record of finding very attractive companies like ABC Clio, who we found 2 years ago. Thank you. And there's a slide showing the other counterbalances in our portfolio, the portfolios. First of all, channels. We're in print, we're in ebooks, and we're in audiobooks. Secondly, territories. We've now got 76% of our sales coming from overseas, and we're not as tied as we were to the vicissitudes of the UK economy. So that's a great strength for us, and we're particularly doing well in America. And then finally, markets, as I just discussed, our portfolios. Thank you.
So coming on to our academic and professional division. So here we've delivered revenue of 36.4 million in the first half. And as I mentioned earlier, consolidating that exceptional H1 growth last year of 38%. I touched on the accelerated shift from print to digital. So we've been planning for the print to digital shift in this market for well over 8-9 years now. But that's actually accelerated even faster than we were expecting in this first half. So this is pretty much a pure play swap from print products to ebooks. That suits us very well. We get good pricing on ebooks, and also we don't have any of the operational challenges of print. So the margin here was 16% for the first half. That's in line with the full year margin on this division last year, and that's very much as we've guided to for this division. If we move on to look at more detail at BDR. So just a reminder, our BDR strategy is to build high margin, high quality, repeatable digital revenues and accelerating our growth with acquisitions. We've done this very successfully, as many of you know. So we increased our subscriptions to 47% of BDR revenue. So really building on that repeatable point. And we've maintained our renewals rate here at over 90%. And we've consistently kept that at over 90% since we first started this business. So we've built the subscription revenues and we're maintaining them and building them. So this talks about our BDR strategy a bit more, and a reminder that our growth target here is our next 5-year target. We smashed through the last one, is to achieve 40% organic revenue growth over the 5 years to February 2028 to reach 37 million of turnover. And that's organic. So future acquisitions, and as many of you know, many of our acquisitions have fed increases in BDR, either through increased content from the print side or with ABC Clio, both increased content, but also buying more digital products and access to new markets. So anything from future acquisitions will be in addition to this target. We also remind our audience of the scale of the opportunity here. So globally, the addressable academic institution market, these are higher education institutions, we're in just over 50% of those. And that's people who are taking one or more products, but they may only be taking one product here. And the schools market, and that's a market we gained access to through the acquisition of ABC Clio. We're in less than a fifth of that market. So again, you can see the scale of the opportunity, and it's a combination of the opportunity and our confidence and our demand for the content that forms the basis for our confidence in our future target. So moving on to our smallest division, which is special interest. This is around targeted publishing for these specific communities, and our targeted publishing strategy is paying off. We're very pleased with the 7% revenue growth, and we have an ongoing drive to profitability here.
I referred earlier to the second half weighting of the traditional Bloomsbury. Of course, the adult trade list was the core of the original Bloomsbury, and it is very oriented to the gift market. So we never look to the first half to be the major part of the year in this division. There was some growth in sales, 8%, and a flat profit. But since the period, we've seen a number of bestsellers. Just sticking with this here, we've had some great prize victories with Trespasses by Louise Kennedy and a number of other books. In the children's division, it's a different story, where that is up 22% and profit is up 29% to 11 million. We're benefiting particularly from Sarah J. Maas, who's mentioned in the right-hand tablet, and that is not a gifting purchase. Those are fans buying her books for themselves, and regardless of the time of the year. Harry Potter has also had a good period and a good post period, because in October last month, after the period end, we published the Harry Potter Wizarding Almanac, which has been a massive success. It got to #1. We print it for the American market. For Scholastic, it's got to #1 over there and to #3 in the UK. On the next slide, we drill down a little bit on the fantasy market, because it's become an important driver at Bloomsbury. In many ways, it always has been because of Harry Potter, but with Sarah J. Maas and Samantha Shannon and the sister genre, if you like, of science fiction with the Three-Body Problem Netflix series coming early in the new year. This has been a fantastic genre for us. The overall market growth, as you can see in America, is a stunning 91% and 41% in the UK. And on the next slide, we give a report card on our achievements against our long-term growth strategy goals. And I won't run through those one by one because the report is very clear there. But just to emphasize in the bottom tablet, the importance of US revenues increasing to be 46% of group revenue. Again, that is in fulfillment of a long-held strategy to try to reflect in our own turnover the worldwide book market. And of course, America is the biggest English language book market in the world, where we have been underweight, and we're now coming back and doing really well there, both in academic and in general books. On the next page, we talk about ESG. I'm sure for many of your own organizations, this has been a dominant theme of the last 3 years, and the changes that we've made have really benefited us. We've won 2 awards in the industry for diversity and inclusion. In fact, we won 1 City Award, the Master Investor Awards in June, where we won Small Cap Company Diversity and Inclusion Award. So we're really pleased about that. We've launched a brilliant mentorship program and a number of other initiatives. In sustainability, our track record has also been good as we seek to reduce our carbon footprints, not only directly in our company, but through the third-party suppliers who are the major producers of the carbon that we are the catalyst to, namely printers, shippers, and carriage companies. And finally, on ESG, we say in the right-hand space, Bloomsbury's core business of publishing books to inform, educate, and inspire is itself a social good. Thank you. And then if we take a look at the actual books that will carry us to the end of the financial year. As I have alluded, several of these have already become bestsellers since the period we're reporting on today ended on the 31st of August. We're all going on a ghost hunt. The marvelous children's book got to #1. Ghosts, tying in with a television series of that name, is also in the top 10. The Harry Potter Wizarding Almanac, as I say, has been a big bestseller. Impossible Creatures by Catherine Rundell. And then the rest is history. Many of you will know the famous podcast of that name, and this is a sort of miscellany of historical facts based on that series and compiled by its two famous podcasting authors. And finally, right there in the middle, the Sarah J. Maas Spectacular. That's coming soon. And finally, this is the summary. We are finding resilient demand for our content in both academic and consumer. We're on track for our BDR target. We are benefiting from the flywheel investment in content, driving strong consumer demand and generating cash for further investment. And finally, we're confident of achieving market expectations for the year end, which is now about 3.5 months away on the 29th of February. Thank you very much.
Nigel, Penny, if I may just jump back in there, and thank you very much indeed for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while the team take a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Nigel, Penny, as you can see, we have received a number of questions from investors, and thank you to all of those for submitting their questions. Penny, if I may just hand over to you just to chair the Q&A session and just read out those questions and give your responses where appropriate, and then I'll pick up from you at the end. Thank you.
Thanks, Jake. So the first question is why make the change of dividend phasing now, and is this phasing going to continue in future years? So Nigel talked at the top of the call about the success we've had in building the portfolio and changing, and fundamentally the strengths of that, meaning that we are much more of a balanced business now. And that means that we're in a position to move from this very second half weighted final dividend. So it was between 85 and 90% of the full year dividend. We're confident that now we're sort of 3-4 years into this much better weighting, that we're confident in making the change now. And yes, absolutely, this is a permanent change. So we're expecting this pattern to continue, and therefore we think this is a sensible reflection in the dividend. The next question is about BDR and the schools market, about the competitive environment, and building out our products. So essentially, by expanding into this market, it's the reach in the market. So we have with the ABC Clio acquisition, we bought a dedicated and very good school sales team, and it's about expanding their reach. So this is essentially the people we're not selling to tends to be people we haven't yet met. It's or people who are not yet using the full scope of the digital products that they can. So I think the case for using digital products has now been very much made for us very effectively. Students want and expect it. Faculty staff, teachers or higher ed staff absolutely expect that content, and to be able to use that content in this very effective way. It's far more powerful than the sum of ebook titles. So it's a very, very powerful tool. So it's a question of reach and getting into those schools. Just reviewing of this, we've been asked about adult consumer sales being a lower margin business, and I think sort of structural and strategic importance to Bloomsbury of adult. Nigel, would you like to take this?
Yes, well, in the adult trade division, which was, if you like, the original part of Bloomsbury, we are very much in the hit business, like people who are in music or in films or television. So not only do they not typically occur in the first half of the year, sometimes they don't occur at all in a particular year. But that doesn't mean this isn't a great area, and many of the group's most successful books in the last 37 years have come precisely from this division, and sometimes giving the adult trade division a really bumper year. As I've mentioned, we've had a number of bestsellers since the August 31st reporting period, so you'll have to watch this space. And also to say there is no major publishing group that doesn't have an adult trade division, because not only is it, in a sense, casting the mantle over the rest of the company's reputation. It's what you become famous for with your big bestsellers. But secondly, it's the area where you can have real runaway successes. And so the key at Bloomsbury has been to counterbalance that volatility, which is an attractive volatility because it can create explosive upside potential for shareholders, but to counterbalance it with a steady, more predictable, higher margin activity of academic publishing. So in effect, we've hedged against the volatility with the academic side. We're an unusual company in having done so. We've made a big success of it and welded it into one lean unit with 5 of the 7 departments in publishing being shared: finance, production, HR, legal, and so on. And only the commissioning of the book side and the marketing side are separate. So there's been great strength in this portfolio of portfolios.
The next question is talking about growth in the BDR division and where that's likely to come from. And so I think, just to reiterate what we said earlier in the presentation, we are ambitious for growth both through acquisitions and organic growth. We've stated very explicitly our organic growth target, which is a 7% CAGR. But also we've said we can't quantify it, but also we intend to continue our very strong track record of building BDR through acquired content, but also potentially acquired platforms. So the next question was about would we consider with our cash balance, would we consider share buybacks or special dividends? And I think to be very, very clear here, we see more opportunity for growth through investing the cash as we have done in the past, through organic growth and through acquisitions. If there was in the future a time when we felt that we couldn't achieve that same level of growth, then we might consider alternative uses of that capital allocation. But just to reiterate, we see more opportunity there. Just going down, I think we've covered a lot of this. There was a question about a strong balance sheet. That's excellent. Thank you for that comment. What is the right capital structure? Well, we believe we have a sensible capital structure. As we've said, the cash balance that we've been building up, our main priority for that is to be able to reinvest it both through organic and acquisitions and generate future growth. So that's how we intend to optimize future returns. and really get the value that we think, we believe, and we know is in the business. That's fine. And one question about someone's picked up from the annual report, one customer accounts for 26% of all sales. Is this Amazon? We couldn't possibly comment, but that's not an unreasonable proposition. I think in terms of, is there a risk around that level of concentration? Nigel, would you like to comment on that?
I think Amazon have been a fantastic contributor to the growth of all publishers, making books available 24 hours a day, 7 days a week, and with their fantastic range of distribution centers and very speedy delivery, not to mention the leading position they've taken in the ebook market and the audio book market. In terms of risks, I wouldn't make a comment on that, but I would say that the government has, and the governments of most countries are concerned about that. So in the UK, the Digital Markets Bill is presently going through the House of Commons, and its aim is to rein in some of the unbridled power of tech platforms generally, without naming any one of them, as you have done in particular. So that's going to include Facebook, Google, Amazon, and so on. And that is a good thing, I think, because it's very difficult to get this right, and the people who seem to get it the most right are regulators. Indeed, it is the case that the EC, who are ahead of us, passed their own digital markets bill over a year ago, and that's had a calming effect. And in the United States, the Federal Trade Commissioner, Lina Khan, is currently taking action against certain large digital companies on particular business practices. But to wrap up on this, the plan in the UK is to work through the CMA, the Competition and Markets Authority, who have created a substantial unit called the DMU, the Digital Markets Unit, run by Will Hayter, and their job will be to act as, if you like, the policeman on this issue. The same thing happened in 2013 when the grocery industry, supermarkets who were sometimes feared for their rapacious treatment of suppliers, both big and small, dairy farmers, you name it, even big multinational corporations supplying them. And there is now a grocery adjudicator at the CMA who oversees the relationships of 13 named supermarkets with all of their suppliers. So it will no doubt be a good thing for all suppliers of tech platforms that this regulation is heading our way soon. Thank you.
So next question is about AI and what opportunities and threats that presents to Bloomsbury. So Nigel, are you happy to pick that one up?
Sure, no problem. The AI is an interesting one. Of course, most of us had never heard of ChatGPT before February. I think it was only started a year ago, last November, and upgraded in February. And now people talk of nothing else. So for book publishers, as opposed to humanity as a whole, it represents quite an opportunity. There are lots of things that generative AI can do in the work processes that we follow as publishers, such as writing blurbs for jackets and advanced information sheets for marketing purposes and all kinds of things. So the skill, the art for us as an industry will be to be able to benefit from those good things whilst not being damaged by the bad things. And the bad thing in particular that we are concerned about is if AI is allowed to train, to use their euphemism, for scanning a book and ingesting it and using it as part of what provides the answer to a question. I'm sure most of you have tried it, and you could tell it to write a history of your company in Shakespearean iambic pentameters, and it would duly oblige. So it is remarkable. It's still also, as you know, unreliable due to these things called hallucinations, where 98% of an answer will be factual and 2% will be a wild hallucination of something totally wrong and way from left field. Does this represent a commercial threat to Bloomsbury? We think not, but we'll have to see. The reason we don't think so is that the books we produce are not generic information. I think those are threatened. But we produce books by famous in their field authors, famous philosophers, architects, theologians, you name it, on the academic side, and students and researchers and academics themselves want that book by that author who has a unique take on the issue concerned. Similarly, in the general side of the business, if you've seen a lot of publicity on television about Tom Kerridge's barbecue book, you don't just want generic information about barbecuing, you want Tom Kerridge on barbecuing. And similarly with our novels, I imagine AI can produce a credible fantasy novel, but if you're a fan of Sarah J. Maas and you're following the unique worlds she's created in 3 different series, you don't want to read any old fantasy novel, you want to read Sarah J. Maas. So I think the fact that from its origins, Bloomsbury has taken the quality high ground of seeking to publish works of excellence and originality, that will in the end be what protects us from the robots, because people will be seeking the authority of our very famous brand name authors, even if that's in a small field as well as a big field. Thank you.
Thank you, Nigel. And I think we've got the final question here, which is the timeline and future Sarah J. Maas book releases, which are obviously very important to us. So her next title, which is the 3rd in her Crescent City series, comes out on the 30th of January 2024, so that will fall into this financial year. And thereafter, we have 6 further contracted titles, so continuing this series and starting a new series as well. But we don't have, we haven't released dates for those yet. You'll hear as soon as we have those confirmed. And on that note, Jake, we'll hand back to you. Thank you very much, everyone, for these excellent and very wide-ranging questions.
Penny, Nigel, thank you very much indeed for being so generous of your time there and addressing all of those questions that came in from investors this afternoon. And of course, if there are any further questions that do come through, we'll make these available to you immediately after the presentation has ended, just for you to review, to then add any additional responses, of course, where it's appropriate to do so. And we'll publish all those responses out on the platform. But Nigel, perhaps before really just looking to redirect those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments just to wrap up with, that would be great.
Yes, thank you very much indeed, Jake. Well, I think I should emphasize that in the months of September and October and the first week or so of November, we've seen a continuation of the good momentum that we had achieved in the period being reported on. So we're really pleased that, if you like, not only has nothing gone wrong, but that the momentum is quite robust. And we're only as good as the individual books that we publish. And it's been so good to see a number of those that we've prepared campaigns for sometimes up to 2 years before releasing them, just in the last 6 weeks or so. And it's good to see them working well. I mean, of course, we are still living in very difficult times, and many people are suffering from the ravages of inflation on their household budgets. So we remain fortunate that, not through any great act of genius of our own, but that our product is very cheap. An average book might be £6.99 for a paperback. And compared to other items of household expenditure, because we're cheap, we're probably not one of the first to get cut back on, because we're not going to make a big difference to somebody if we are cut back on. I think the second and final closing remark I would make is about another bit of good fortune for being a book publisher based in Britain or America, which is the English language. And the spread of the English language continues. It's really become the software with which the world, much of the world, chooses to communicate, even where it's two people for whom English is not their mother tongue. They will use English as the thing they have in common to speak to each other. And that can be very important in some areas, such as air traffic control, where English was, I believe, made the international language of air traffic control in the 1950s. So this has a big impact on our book sales, that we can sell books in English in considerable quantities in China and other countries in Asia, a growing market, in India, where there are more English speakers than in Britain and America combined. So this is a kind of gift in a way, because we have such a wide ready market for our books. So on that note, I will close by thanking you all very much for coming to this call. It's very good to speak to you and to tell you the good news about our first half, and the good news about our strategy, really, which has worked and has been more than 10 years in the making, to create this balanced portfolio of portfolios, balance between the two halves of the year and balance between the two very different markets of academia versus the high street. And that really has been one of the great secrets of Bloomsbury. Thank you all very much indeed, and over and out.
Nigel, Penny, that's great. And thank you once again for updating investors this afternoon. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback, in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Bloomsbury Publishing PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.